Good day to you. Don't know whether it's morning, evening, or night, but it's good to have you come in and take a look at what we've got to offer you. The next unit is going to be on basics of accounting, and I just want to give you somewhat of an underpinning so that some of these concepts, as we get into them and we start using the computerized system, you kind of have a basis for it. Those of you that have taken Accounting 1 and possibly even Accounting 2, this is going to be just rhetorical to you, and probably not necessarily so much, but it might be a good quick review too. You don't have to be an accountant, but it doesn't hurt to have a basic understanding of accounting in order to be a good record keeping or a keeper. And one of the things that I think is really important, some people subjugate some of the responsibilities of bookkeeping to other people because the owner, manager, if that's you, don't quite feel comfortable with it. But any good manager that I've been around actually has a good basis and is comfortable around record keeping. They don't have to do the mundane tasks of data entry so much. In fact, that's a great kind of responsibility to delegate to somebody else, but they definitely have a good handle on what's going on internally, financially, and operationally throughout the whole business. So you might keep that in mind. I just am going from looking at lots of I might say failed businesses, but mostly trying to track businesses that have been successful. And sometimes those businesses, I've followed them to the degree that, they've regenerated themselves because of the fact that the manager became a better record keeper and had some accounting underpinnings, as it were. Okay, as we get into it, the fundamental accounting equation is so important, and it's so simple when he gets right down to it. There's three things that are involved. Assets always equal your liabilities plus your net worth. If this gets out of whack at all, then there's a problem with anything that we do. Any kind of transaction within a record-keeping system has to meet the criteria and keep this accounting equation in balance. Assets equal liabilities plus net worth. Okay, and net worth is also called equity. So if you hear those things, they're interchangeable. Now, if we change that around just through laws of mathematics, we can also say liabilities equal the assets minus your net worth. And there's a couple different ways that we can look at this, but those are the ones that can be very useful when we think about accounting in general. But the basis for all accounting is this one fundamental equation right here. And I might say this too, and this isn't any kind of a quip at any accountants or anything like that. They certainly earn their keep. Again, I keep pointing these kinds of things out. Most successful operations, as one of the consultants that are involved in an operation, typically there is a good accountant that you can lean on in a lot of cases. So accounting is simply adding and subtracting. There's no more to it than that. There's some complexities to it, but adding and subtracting are fairly simple. And so I don't want to intimidate anybody with any of this kind of material, because accounting is just plus and minuses. And when to do it sometimes becomes a little bit more complex. So anyway, there's the accounting equation. You need to learn that and memorize it, and you should keep it with you the rest of your life, actually, if you're going to be a great financial record keeper. Defining some of the terms within that equation, and again, this might be a review for many of you, probably is, but the assets are any item owned or controlled by the business that has value, or any item owed to the business. Okay, and of course we can think of lots of things. Liquid assets would be cash, stocks, bonds, things that are easily convertible into cash, savings accounts, checking accounts, anything like that. Any items owed to the business, the business may have made a loan, somebody owes the business, so that actually is an asset to the business. Okay, and it might be long term, it might be short term, and they would fit into different categories as a result of that. Okay, non-current or long-term assets have a useful life of more than 1 year. Okay, all that are not current assets, and we'll probably define current assets. But again, though it's kind of a catch-all. Anything that has a useful life of over 1 year, those are non-current assets. Those would be things. Think of all the things that are fixed in nature, and also those things that generate income on a long-term basis for our businesses. And if we're talking about agriculture, of course, we're talking about things like cows, maybe ewes, and things like that, sows if you're in the hog operation. It also would include buildings, improvements, land, houses on a farm or ranch, headquarters facilities, shops, fencing. All those kinds of things would be considered long-term or non-current assets. Okay. Now, since I didn't define it here, I will right at this time. Current assets are anything that is very liquid or could be used up in the next year. Okay, so the ones that I mentioned before that would be considered current would generally be cash, checking account, savings account, stocks, bonds. Those are all convertible into cash. We would have, if we're in the cattle business, we would have calves. Those would be liquidated and converted into cash during that 1 year window. And any kind of livestock that would be convertible into cash within 1 year. Okay, so they're not the things that are generating income, but they're the things that you actually are in business to sell in most terms. Okay, so you wouldn't have anything involved in there that would be well, things like land and things like that, as we define, would be non-current or long-term. Okay. All right. One of the things that I missed out on when I was talking about non-current assets, of course, would be any equipment you might have, trucks, vehicles, and those kinds of things as well. So it's kind of right there. Liabilities. Okay. Liabilities are a debt or obligation expressed in terms of money. Okay, so we're going to put a value on the amount of the obligation. Also referred to leverage, how much you're leveraged. Any amount owed to someone or something. Okay, and something could be, we're referring to entities like corporations, partnerships that aren't an individual person. Okay, so which would be a very common thing. John Deere Corporation, we might owe them in the form of farm plan, and we might owe them in the form of equipment debt. So a current liability is liability which is due in 1 year. Some examples of those things would be an operating note, accrued interest that you will pay within the next year on the long-term debt. So you can see there's portions of maybe something that would be considered long-term, but it becomes current because you're going to pay it the next year. The principal portion of a note or a debt which is due within the next year of long-term debt. Okay, so even though it may be actually something, a 10-year note or a 20-year mortgage or something like that, that which is due in the next year is considered current. accrued interest or income tax, that income tax which is due in the next year, accrued, and that would be also a current liability. Okay. So a long-term liability is everything else, right? Okay. So any debt owed to be paid in more than 1 year. So notes on breeding livestock and machinery. So they're notes on those productive assets or assets which are producing income. If you owe money on them, then that would be considered a long-term debt, long-term liability. Mortgages, notes on longer-term assets would also be considered long-term liabilities. Okay. Net worth. Okay, we're going to kind of buzz through these. Hopefully, try not to make too long of a video for you to watch. But net worth is also, as I explained earlier, is also synonymous with equity. Okay, net worth equals the assets minus the liabilities. That's how we determine it. If we turn the mathematical equation around, it's the value of the owner's equity within the business. Okay, owners, there may be multiple owners, so we're not just talking about one individual. And what the business, it is what the business is worth, the net worth. If we were to take the liabilities away, pay them off, how much would be left after that? Assets equal what the whole business is worth. The net worth equals the owner's share of the business. Liability equals the entity's share of the business. So the liabilities is the equity of others besides the principal owners in the business, if that makes sense, hopefully. Okay, I'm going to stop right there, and